All right, so today we're diving into a world where those huge corporate headlines you see, they aren't just noise. For some people, they're a signal. We're talking about something called event-driven investing, a pretty sophisticated strategy that the pros use to find opportunity right in the middle of all that corporate chaos. I mean, seriously, think about it. You see these headlines every single day, right? A huge merger, a company spinning off a division, a big regulatory change. For most of us, it's just news. But what if that announcement itself was the investment? For a certain kind of investor, that headline is basically the starting pistol for a very specific, highly calculated race.
So, what are we really talking about here? At its core, event-driven investing is a strategy that hunts for those temporary price gaps. The mispricings that can pop up right around a major corporate change. The key here isn't trying to predict the stock market 5 years from now. No, it's about zeroing in on the specific upcoming event, one that has a pretty clear timeline, and most importantly, a probable outcome.
Okay, so to really get a handle on this, it helps to see how the pros categorize these things. They basically group these opportunities into four main types of catalyst events. Let's break down that framework. First up, you've got the big one, the classic. Mergers and acquisitions, or M&A. This is probably where the strategy gets its high-stakes reputation, because it focuses on those announced deals where one company is trying to buy another. Now, the main play here is something called merger arbitrage. So when a buyout is announced, the target company's stock usually jumps up, right? But it almost never hits the full offer price right away. So why is there a gap? Well, that little gap, that's the market's collective doubt priced in. An investor practicing merger arbitrage buys that stock, betting that the deal will close and they can capture that final spread. The risk, of course, is massive if the deal falls apart. All right, our second category isn't about two companies getting together, but about one company changing its own shape. This is corporate restructuring. Just think of it like a company rearranging its own puzzle pieces to try and unlock some hidden value. So this could be a spin-off where a company carves out one of its divisions and creates a whole new independent company. Or maybe it's a huge share buyback. The strategy here often comes down to what's called a sum of the parts analysis. It's basically doing the math and figuring out if the individual pieces of the company are actually worth more on their own than they are all lumped together. It's all about unlocking value that the market wasn't seeing before. Okay, the third type of event is something that happens way more often. We're talking about a timeline of weeks, not months. Earnings and guidance reports. This is all about how the market reacts to a company's latest numbers and its forecast for what's coming next. So, every quarter, public companies have to report their financial results. The real game here is to find the surprise. You're looking for a company that does way better or way worse than all the Wall Street analysts expected. A big earnings beat, as they call it, can create this powerful wave of positive momentum. But you got to remember, it's a much faster, shorter ride than a complex merger. And that brings us to our fourth and final category, one that can have these massive, industry-wide effects: regulatory and policy changes. This is what happens when the government decides to change the rules of the game. Think about something like a new drug getting approval from the FDA, or new capital requirements for banks, or even big shifts in energy policy. These things don't just hit one company. They can lift up or sink an entire sector. The strategy here is all about understanding the ripple effects of that new rulebook. So, there you have it, the four main playbooks. But to really get this, let's zoom in on merger arbitrage and see what that process actually looks like. Because this is not about a gut feeling. It's a deep, detailed investigation. Yeah, to figure out the actual odds of a deal closing, the pros run through a mental checklist that looks a lot like this. They're asking some really tough questions. Could regulators block this on antitrust grounds? Does the buyer actually have the financing lockdown? I mean, does the deal even make basic business sense? It's all about turning a splashy headline into a set of cold, hard probabilities. And this is where you can really see that not all events are created equal. Look at this. A simple cash takeover might have, say, an 85 to 95% chance of closing, with a huge potential impact on the stock price. Now, compare that to an earnings beat. The potential payoff is a lot smaller, and the probability of a lasting pop is lower too. Each type of event really does require a totally different kind of analysis.
And that brings us to maybe the most crucial point of all. With all this potential opportunity comes some very significant risk. And I want to be clear, this is not gambling, it's a discipline. And that discipline is built on a super strict set of rules.
The first rule, the most important rule, is all about survival, position sizing. It doesn't matter how much of a sure thing a deal seems, a pro will never bet the farm on it. By capping any single investment at just, say, 3 to 5% of their total capital, they make sure that if the unthinkable happens and a deal collapses, well, it's just a setback. It's not a portfolio-ending catastrophe.
Okay, rule number 2 is the stop loss. Think of it as the pre-planned eject button. Before they even buy a single share, an investor defines their absolute point of failure. If that stock drops by a preset amount, maybe it's 15, maybe it's 25%, they sell, period. No second guessing, no hoping, no waiting. This one piece of discipline is what separates a professional system from just a reckless gamble.
So as we start to wrap this up, it's pretty clear that event-driven investing is this constant balancing act. It's about identifying a real opportunity on one side and managing the very real risk that comes with it on the other.
Ultimately, success in this world really comes down to this balance. The principles for success, focusing on high probability events, managing risk like your life depends on it, they're the direct countermeasures to the biggest dangers, like a deal breaking or a surprise regulatory change. Look, there's a reason this is a specialist's domain. And that really leaves us with one final thought to chew on. While everyone else is focused on the merger announcement or the earnings date on the calendar, maybe the real event isn't out there at all. Maybe it's the internal commitment to a systematic, disciplined process. Because in the end, that's what truly separates the signal from all the noise.